Good morning, Good morning, everybody. Thanks you for joining #Adulting. This is our third year that we're offering this program. And I want you to know that this program, as Brenda rightly said, I do lots of the grunt work, but in addition to us offering this program to you as part of your learning at Mount St. Vincent University, our Dean of Business and Professional Studies, Dr. Susan Trenham, she is the sponsor. Her department is a sponsor of this program. It allows you to really improve your financial literacy skills, helps you to manage your personal finances. It may also help you with your family or your business finances. The other piece to this is that there are many students here who may want to utilize this course as part of the Learning Passport. I hope that when you fill the application, the registration form, that you check the box for Learning Passport so that we're aware of who needs that credit. In addition, I see there's some people here with just their first name. In order for your attendance to be registered properly, you need to have your first and last name. So for example, Alicia's cell phone, iPhone, you need to say your first and last name, Humana, Fabiola, etc., so that we can record these things accurately, that you were here, and if you need Learning Passport credit, you can get that. Thank you for joining us this morning and over the next 6 weeks. I've been through this program a few times now. There's a lot to learn. Myra is a great presenter, and then she's going to have Danny as well supporting her. If you have any questions, don't hesitate to use the chat box. And make yourself known. Turn your camera on and ask a question. If you don't know how to change your name, you can simply go to the highlight the box your name is in. There's 3 little dots. You click on those dots, and then you scroll down and it says rename. If you don't have that, you can go to participants. You can find your name in the participant box, and to your right, there are the 3 dots again. You can click on that box, on those 3 little dots, and find the rename as well. Okay, perfect. Okay, well, good luck, everybody. Thanks, Myra. And we look forward to having a much more financially sound and savvy student body at Mount St. Vincent University. Thanks, guys.
Thank you so much,
Natalie and Brenda. Yeah, I just wanted to say one other thing. I know Natalie touched on it, but we're more than happy to have your cameras on. You can certainly have them off if you are more comfortable that way. But if you're comfortable, then feel free to turn them on. It's great for the presenters to see who they're talking to. And it just makes it a little better than just talking into the air. But if you're not comfortable, that's completely okay as well. And if you have any questions, Amira loves questions. And so you're more than welcome to turn on your mic to ask questions, or you can type them in chat, and Natalie and I will be keeping an eye on chat to make sure that your questions get answered as well. So turning it over to Myra, I'm going to turn my mic off. Thank you, Myra. And
Thank you. Thank you. So welcome, everybody. Thank you for joining us today. To let you know a little bit more about myself, I have been in the banking industry, excuse me, for 25 years now. Doing a variety of roles. Financial literacy is one of my passions, and I believe that we don't do enough, even in the banking industry, to educate the Canadian public on what their finances mean and the choices that they have. So I'm really happy to be here today. Like Brenda mentioned, I love questions. The only way that I know that this is going to be relevant to you is if you ask questions. Feel free to use the chat at any time. You can certainly interrupt me at any time. I don't like to just wait until the end of the session for questions. If something strikes you as we're going through the material, then absolutely stop me and ask, okay? And I will ask a lot of questions too, so I'm hoping that you guys will have some answers. And you know what? Chances are you know more of this than you think you do, so please throw out answers. We'll discuss them as we go through as well. So let's get started. Today, we're talking about debt, different kinds of debt, and a bit of how to, well, the terms around debt, and a bit about how to manage some of the debt. So we are going to start. I'm going to try and share my screen here. There we go. Can everybody see that? Okay, thank you, Brenda. So we're going to start with a little video, and I'm hoping this will work.
I think we usually put the video link in the chat and let everybody watch it because sound is the problem.
Let me help you. Go back, Myra. Stop sharing. Okay. Now go to share again. Go to share again. Try sharing your screen again. And then on the lower left, don't share it yet. Don't share it yet. I'm just giving you an instruction so the sound will share. So go to share, choose what we want to share.
Share sound.
Okay, share sound. Okay, perfect.
Gotcha. Okay, so I'm hoping this will come through. Let's give this another try.
We need some more volume, I think. You want to send me the link and I'll share?
Okay. Just give me one sec. Brenda, are you able to share that link? Sorry, you're on mute, Brenda. We will definitely get that link out to everybody so that you can watch the video. But let's go over, sorry, what we're going to learn today. So this is module 1. Oh, and before I forget, we will have a very short break. It is 2 hours long today, but we will have a very short break. I'm going to have to refill my water jug and probably just take a quick break. So don't worry if you're wondering about that. It isn't the whole 2 hours straight.
Myra?
Yes.
Sorry, I have the video up if you would like me to share.
Sure, yeah.
Okay.
Excellent. There you go.
Okay.
What's up, y'all? Coming to my crib. Damn! Yo, that crib is blazing, yo. But that house would have cost way more than 1/3 my gross monthly income. So I opted for a more modest crib that would help me to achieve my long-term financial G to the O's goals. 2 bedrooms, 1 1/4 bath. Fixed rate mortgage at 5.25% plus 20% down shrinks my risk of foreclosure in the event my crib loses value in the short term. Boom! That's math all over your face. Yo, stay with the tour, kids. This is my main whip, AKA my only whip. It's sitting on the 14-inch rims. I get the weather and the traffic, and I get 20 reggaeton stations. Boop, boop. Plus, you know I'm getting 38 M to the G highway style. That's good for the environment in my pocket. Gotta keep it green, yo. Welcome to my crib. Feel free to take a look around. This is the great room, living room / office / media. Over here, I got the 27-inch television and my new PlayStation. And check this, my brand new couch I got from my boy Craig. Just one of the many items on this dope-ass list. Keep this. That is genuine velour right there, 100%. And this couch, not to brag, is also a bed. Transformer! This is the kitchen where I get my eat on. I got the refrigerator. I got the stove. I got the dishwasher. All Energy Star compliant, yo. I save so much money on my electric bill, I keep the fridge stocked with bubbly. Bubble bath soap. That's what I use to clean my feet. This is the inner sanctum. Very few people get to see this. This is where the magic happens. See, since I kept my crib within my means and bought adequate insurance and set aside a small rainy day fund in case I lose my job, I feel financially secure. I'm worry-free. I sleep like a baby all night long. Yo, Professor Puggleface, you feel good about our sound investments? Roar, 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 roar. Oh, staying cool by the pool, y'all. Every single night, this pool is straight filled with hoes. Yo, where my hose at? Oh, there it is. Well, that's it. I'll catch y'all on the flip. And in the meantime, keep your spending tight and keep your money on your mind. I'm out.
The Kia Seltos will inspire many memorable journeys.
Right, thank you, Natalie. I appreciate you sharing that for us. And I hope everybody enjoyed that. It's kind of a funny little video, but it makes a lot of really good points about living within your means and not getting into overwhelming debt. So to move forward, today we're going to learn a little bit about what debt is, the role of lenders and creditors. We'll learn some things about interest and the different types that there are, advantages and disadvantages of credit, types of debt and repayment options, and types of loans and how amortization works. So let's get started. So what is debt? You know, and without reading the slide itself, what does anybody want to share what their own personal definition of debt is?
It is liability.
Exactly. Mm-hmm.
And well, something that we own to another person, to a bank, or
Yes.
yeah,
Yep.
so that's it.
Those are great ways of describing it. Anything that you owe to someone else is debt. And then also saying a liability. It's another term for debt. So one thing that I want to discuss as well is that people will use different terms to mean debt. You've heard in the video and you've heard us and probably a bunch of different times, you've heard debt and you've heard credit and you've heard liabilities, payments owing, things like that. All of that is still debt. And one thing that I want to caution everybody about is when you hear debt and credit, you want to understand that those are actually two different terms, but people use them interchangeably quite often. So credit, as far as the definition goes, credit is what you could borrow. So when you get a credit card and you have a credit card limit of say $2,000, that is the credit that was extended to you. Or if you have, for example, you know, a line of credit. Again, whatever the limit is, say it's $5,000, a student line of credit, that is the credit that is extended to you. The debt is once you've used some of that limit, what you owe is the debt. So is that a clear distinction between those two terms? Credit is what you could use, debt is what you have used, okay? Unfortunately, people use those terms interchangeably. So when you're hearing somebody talk about credit, you're going to want them to clarify for you exactly what they mean. Or when they're talking about debt, ask them to clarify exactly what they mean, because they are two separate terms, but they're used interchangeably these days, and they do mean different things. Any questions about those? No? Okay. So some of the things that we're going to learn today is about lenders and creditors. So does anybody have examples of the difference between a lender or a creditor?
I think lender is somebody that, oh, creditor is the person who borrow the money, and lender is the person who give the money to the creditor.
That's a good guess. Lenders and creditors are the exact same, actually. It's just that those two terms will be used interchangeably as well. So lenders or creditors can be banks. They can be credit card companies. Do we have any other examples of maybe some lenders or creditors that you use yourselves?
Suppliers.
Suppliers can extend credit to companies. Yeah, absolutely. Any other examples? We have a bit of a quiet crowd there, so I'm hoping that we get you up and running on a Friday morning. So any other examples of lenders or creditors?
In the
Sometimes.
chat, we have banks, sorry to interrupt, and bill companies.
Perfect. What do you mean by bill companies? Can you expand on that a little bit?
Like lights, like power company, your internet.
Yeah, exactly. They provide a service with the expectation that you will pay for it, but you don't necessarily pay for it up front.
And Sydney also said credit unions.
Absolutely. Absolutely. We are banks. So yes. Thank you for that, Sydney. All right. That's really great. There are some, other creditors or lenders. The government does lend. How does the government lend to people? It should be something that should be near and dear to your guys' hearts. All right, we have a shy bunch. So the government can lend as far as, there's student loans. There's a lot of government programs that provide loans to new businesses. There was a lot of loans given out over COVID, especially to businesses. So the government does lend as well. And really any person that's willing to let you borrow money from them or provides you with something that you're not paying for up front is really a lender. Okay, so we can even be as basic as that. So when you borrow money, there are terms and conditions. Besides the expectation to pay that money back, what other types of terms and conditions do you think there are?
So we've got interest and interest rate in the chat.
Absolutely. Anything else?
Time, duration.
Perfect. You guys are so smart. Is there anything else that you can think of? All right, you guys are on a really good track there, but the interest rate and the time and duration will determine your payment. But sometimes, like with credit cards, a minimum payment could be applied, and that could be a term. Okay, or sorry, not a term. It could be a term and condition. So there are lots of things to consider and lots of ways that when you borrow or incur debt, or even just get the credit extended to you, there are lots of terms and conditions that can be attached to that.
In chat, we also have pledge assets, which I suppose would be like having your assets as a backing to the loan. And then somebody, Alicia said, sometimes a cosigner is needed. That would be another term. or condition.
Wonderful. Yes, you guys are right on it. Security and co-signers. Yes. So pledging your assets, I call it security. It's the same thing. So for example, a car loan and the car is the security, or a mortgage and the house or property is the security. A co-signer is a different form of security for lenders and creditors. So does anybody know what the responsibility of a co-signer is?
It is like if it is it's a commitment of the cosigner to pay if the main person do not pay the loan.
Yes, exactly. Exactly. That's a great definition of it. Thank you so much. So that's exactly right. If a cosigner is required, then as a lender or creditor, we make sure that they qualify to handle that payment if you're not able to. The big thing to keep in mind, and sometimes part of the reason why people are hesitant to be cosigners, is it does affect their credit rating as well. So if you don't pay, that will show on your cosigner's credit rating or credit report, and it will affect their credit score. Okay, so it also affects their ability to borrow for themselves, because anywhere that they go, it will be considered, what they've co-signed for you will be considered part of their debt or liabilities when we're looking at how much they already owe and what they can afford. Okay, does that make sense? So I know a lot of you are probably in the position where you've gone for student lines of credit, and just because of probably your age or lack of income coming in because you're students, or potentially lack of a credit history, then your parents or somebody who, another family member, somebody who's invested in you getting your education would be asked to co-sign. And those people are equally responsible for those payments as you are. Okay, and it equally shows on their credit bureau, just as it would on yours. Okay. So what is interest? We had mentioned that as one of the terms and conditions when you borrow. What is interest? That can be a hard one to define. Does anybody want to take a stab at it?
It is a percentage that it is added to the loan, maybe per year.
Exactly, exactly. So interest is what is charged to the borrower for having that money. So for example, when it comes to banks, we charge interest on the money that you borrow from us, because we need to know that should interest rates go up, the money that we're, so let me back up here. A quick explanation of how banks work. Banks take money in, and when they take money in, they pay you a little bit of interest. So interest can be charged and interest can be paid. If you have your money sitting in a savings account or an investment, interest can be part of what is paid to you. So for example, if you have your money in a high interest savings account, say for example, you're getting 1.25% interest on that high interest savings account. So the money you have in there is earning that as an annual percentage rate. The bank technically takes that money and then lends it out to people. And when they lend it out to people, they charge a higher interest rate, because not only do they have to pay you your interest, that's also how they make their money to operate. Okay. So interest is charged for the ability to borrow and use that money. The other thing that you need to consider is interest can be charged, your interest rate itself can be different for each person. And that is actually based on the risk that the bank sees with lending you that money. So if the bank feels, for example, you have great credit, you know, all of your past borrowings have been paid back with absolutely no problems, you'll probably get the lowest interest rate that the bank can offer for that type of product. However, if you've not paid some things on time, if you've had maybe a couple of late payments, or if you're really new to borrowing, your interest rate might go up a little bit because we see a little bit more risk. If you've had issues, pretty severe issues with credit, you haven't been paying for whatever reason, chances are the interest rate will be even higher, or you'll have to go to a different type of lender who is more willing to take on that risk, and they charge even higher interest rates. So interest is what you pay to be able to borrow that money, but it's also dependent on your credit history. Okay, I'm hoping all of that makes sense. Any questions around interest, or does anybody have any experience with paying interest? I know if you have a student loan or a student line of credit, interest will come into play with those. Any questions around that? No? Okay, I know that we're going to discuss this a little bit later on in the module. However, we're going to talk a little bit about the differences between student lines of credit and student loans. But what you'll find, the first difference is in a student line of credit that would be provided by the banks, you are responsible to pay the interest on a monthly basis, even while you're in school. A student loan is provided by the government, and you do not need to pay interest while you're in school. Okay, so there's a bit of a difference there. Something to keep in mind. So our next slide. So different types of interest. Does anybody have any definitions about any of these 4 types of interest? Okay, so there's 4 terms here. We can pair them off because they sort of go together. Simple and compound interest go together, and floating and fixed interest go together. So let's start with floating and fixed. What do we think the difference is between those? Does anybody want to take a stab at that?
Sydney has something in, but it's the simple and the compound. So I'll come back to that when we get to those ones.
Okay, wonderful.
They were typing before you switched to floating and fixed.
Well, we can start there.
All right. Oh, sorry. Is somebody else going to speak?
Yes, about the fixed and floating interest, I'm not sure if it is right, but according to my understanding, fixed interest is, for example, if the interest is 2% and it can be fixed in like 5 or 2 years, then the interest will not change. But for floating means it will change according to some maybe policy or maybe something. Yeah, that is my understanding.
Yes, you have a really good understanding. That's correct. A fixed interest rate will stay at the same interest rate for the entire term. Okay, and we'll talk a little bit about those when we talk about the length of time of the duration. You can have a loan, a mortgage is the best example of this. It can be, over 25, 30 years, but then it's broken down into terms. So you can have a 1 year, 2 year, up to 5 year term. And if you have a fixed interest rate, the interest rate will stay the same for that term that you've agreed to. Floating interest rate, you're absolutely correct. It does change, but what it changes is, or what causes it to change is the Bank of Canada rate. So when you hear, and we've been hearing a lot, we've been hearing so much, the Bank of Canada increases rates to help control the economy. So where spending has been kind of out of whack, the economy is, you know, it needs to be slowed down. Basically, they're talking about a recession, I know, but at this point, it needs to be slowed down. So interest rates go up. The Bank of Canada pushes their rate up, and all of the banks base their prime rate, what we call prime rate, off of that Bank of Canada rate. So as that rate goes up, so will your variable or floating interest rates. So that's another way to think of floating. It's variable as well. I see that we have some more things in the chat. Do we have questions around those, Brenda?
No, it's all more definitions of compound interest and simple. So
Okay.
I was just waiting till we get to
Wonderful.
those ones.
I'm actually really happy that you guys are gravitating more towards that, because that tends to be the more complicated one. So let's jump. Actually, does anybody have any questions with the Bank of Canada and the rate that they use as opposed to the fixed rates? No? Okay. So let's jump into simple and compound interest. What kind of definitions do we have there, Brenda?
Well, Sydney said simple can be one interest, compound can be like monthly or weekly. And then Tanika said compound interest is interest that is calculated on interest. And also we have compound is interest of interest. So.
Okay, that is correct. That is very correct. Where do you think you would see, like what type of lending products would you see simple interest on? Okay, have I stumped you guys with that one? Okay, a really good example of simple interest is the interest that's charged on credit cards. Generally, loans are simple interest. And compound interest is, mortgages. That's the big one. And it depends, some loans can be compound interest. Sometimes we hear more about compound interest with investments, certain types of investments. We hear that more often. We hear a lot about simple interest, a lot more about it just because people use credit cards so much. So we hear a lot more about simple interest. So when you're looking at things like your credit cards, I'll give you a calculation. I think I can put this into the chat for everybody. The simple interest calculation is it's your balance owing. So that would be your dollar amount times the amount of days that you're going to be borrowing that. So when you're talking about a credit card, if you want to know how much interest you're going to be paying on, say, maybe a larger purchase, if you're going to be carrying that balance for a little bit, I usually base it off of 30 days because that's generally what a month is 30 days. You're going to times that by your interest rate. And because interest rates, it was mentioned when we started talking about interest rates are usually described or put out in an annual term. So because the interest rate is annual, you need to divide all of this, divide by 365. So that, I just put it up in the chat there, that is your simple interest calculation. Okay, so like I said, if you're looking at carrying a balance on your credit card because it's a larger purchase that you need to make, or you're considering a lower interest credit card, or doing one of those balance transfer offers, you're going to want to calculate that simple interest. So say, for example, let's do a quick exercise. You've got a balance of $3,000 on your credit card. and you're currently paying, let's say 20% interest on that balance. You're going to carry it for the next 30 days. What is your interest that's being charged? Do we have any answers?
Not so far. Everybody's
It
probably
was-
pulling up their calendars or their calculators.
It was 3,000 per 20%.
Yes. $3,000, 20% over 30 days.
It is 20.
Sorry?
I think it's 20. Let me see again. 3,000 per 0.2 in 30 days is 20. The result is 20.
Okay, I'm getting something different. So
Oh,
you had
really? I'm sorry.
3,000 times your number of days, which is 30, times your interest rate, divided by 365 because it's an annual interest rate.
Oh, I heard 30 days. I'm sorry.
Okay, so do we have, is there something in chat? Does somebody have an answer for us?
Sydney has $49.32.
That's right. That's what I've gotten as well.
Yep, we've got a few of those ones coming up now.
Perfect. Good. It's good to practice that calculation. And again, if you're going to do like a balance transfer from a higher interest rate credit card to a lower interest rate credit card, number one, I caution you about checking into the extra fees that are involved in that, but also do this calculation to see how much you're actually going to save, because that lower interest rate credit card could have an annual fee. There could be a fee for actually doing the transfer. And you're going to want to add those up and see if you're actually going to save more than what that's going to cost you. Okay, so that simple interest calculation is a really good one to keep in your back pocket. Any questions around that? Okay, compound interest, I will not give you the calculation on that because that is not one that I can do myself. So if you need that calculation, there are a bunch of tools. The banks can usually, I'm not sure if they have any of the mortgage calculators on the bank websites. Those would deal with compound interest. So if you want to know, even if it's not a mortgage that you're looking at, but you're wondering how much interest you'll actually be paying, those are good calculators to use. So you can just go to your bank's website and play around with those.
Myra, just a quick thought, and I could be wrong on this, but I know we always say that credit cards have simple interest because in theory, your payment every month is at least your interest, but if a person wasn't paying their minimum payment each month, or to cover the interest, then the next month they would be paying interest on that interest, correct?
Yes, you are correct.
Okay.
So in a way it is compound, but the way they calculate it is through simple interest. But yes.
Yeah. Just an idea that, if you haven't been paying at least your interest each month, then you will then be paying interest on your interest. So it takes you to a bit of a compound.
Yeah, we are going to be getting into the advantages and disadvantages of credit. So again, we're talking about the advantages and disadvantages of credit, which, keep in mind, is actually debt that we're talking about. So it's incurring debt and having the debt that we want to keep in mind there, okay? So having credit, what does that do for you? There's some really quick reasons why you would want to have credit, and then there's some more in-depth reasons why you would want to have credit. So what are some reasons that you guys can think of off the top of your heads to have credit. So we're not talking about the debt at this point. We're talking about actual credit.
It's because you have something available for you in case you need it.
Mhm. So in case of unexpected emergencies, absolutely.
It might be easier to get more, it can help with the mortgage.
Absolutely. So having credit in place now can help down the road to get more credit. Yes.
In the chat, we have you can earn cash back and travel points using a credit card. And it's also going to increase credit scores once you are making on-time payments.
Absolutely. Absolutely. So building your credit is sort of the more in-depth advantage of having credit. Like it was mentioned earlier, if you need to, if you have an emergency and you don't have the cash on you, for example, or there's something larger that you want to purchase, then it gives you buying power, right? Having the credit gives you buying power. You know, it does build your credit history. And it can, somebody mentioned building your credit score, but that can be a double-edged sword. Does anybody know why?
For example, if you don't pay back your credit card in time, it's gonna hurt the score.
Yes, that's the you know, the very immediate reason why that can be not so good. But the other thing is if you have too much credit, or you get a bunch of credit cards all at the same time, that can actually hurt your credit score. Okay, so not only, you know, is it good to have credit or to get credit, but you have to be smart with that as well. Okay, so for example, I'll give you my own personal experience here. Most of us can go on to our banking websites, our online banking, and check our credit scores, and we do that quite often. And they tell us, you know, what range is a good credit score, what needs work, what's really great. So I go on periodically. A couple of things that your credit score can tell you, and there is an advantage checking your credit score at least a couple of times a year. Number one, if you think that you're doing really well with your credit, you know you're paying everything on time, you know you don't have any worries about keeping up with those bills, and you check your credit score, but you see it's, you know, just tanked since the last time you checked it, but you've been doing everything you've always been doing. That means you need to go in or go to your bank or try and get your credit report yourself to find out what's happened. Is somebody using your identity? Did somebody open a credit card in your name that you didn't know about and isn't paying it? So it is a way to sort of keep on top of potential fraud against your identity. Okay, so it doesn't hurt to check that credit score a couple of times a year. Now, my own personal experience was I do check my credit score a couple of times a year, and I was checking it, and some of them actually give you feedback about why your credit score has either gone up or gone down. So my credit score had only dropped, I think it was like 2 or 3 points. So not a big deal, just 2 or 3 points. And the reason was that I had opened 2 new credit cards in a 12-month period. What had actually happened is I had gotten a Costco credit card. So I had opened the one myself, but then it was Capital One, and Capital One, or Costco, switched from Capital One to CIBC. So according to the credit bureau, I opened a second credit card, even though I was actually just switched by Costco, but that affected my credit score and brought it down by a few points. And that was within a 12-month period. So having too much credit can affect your credit score. And sorry, we're getting into the disadvantages. I'm jumping ahead. I apologize. It can affect your credit score negatively. You know, if you manage it well, you do need to be smart about it because it can really boost your credit score as well. So if you get a credit card, for example, as a student, it can be easier to get a credit card as a student because the qualifications are a little bit different. They're a little bit easier as a student. That can help build your credit. But if you do something like, when I was a student at the Mount myself, they used to have tables and they would sign you up for like 5 or 6 credit cards all at once. I fell for that. So, you know, I didn't start off with a great credit score. But definitely having 1, maybe 2 credit cards is excellent. Be careful how you use them. What I suggest is that you put your cell phone bill on your credit card. You know, you're budgeting for that. You're paying it every month anyway. Instead of paying direct to the company, you pay it through your credit card. And that will help build that credit. It's something that you already budget for, like I said. It's not an unexpected bill. And then you can put the credit card away. It's giving you the use of the credit card. It's giving you the payments that you need to make every month, and that helps build your credit. Okay. You might think that you have a student line of credit or a student loan. However, if you're under 19, that's not going to show on a credit bureau for you. Okay, so here a credit bureau start reporting at the age of 19. Any questions about what we discussed there, or any of the advantages, any other advantages that you can think of?
Well, when you build your credit score, you can get a house or something like that.
Yeah, you do need to build your credit to be able to get more credit. Absolutely. But again, you need to be smart with it. You really do. The other thing that having too much credit available, when you, like I had mentioned before, when we look at your debts or liabilities and what your payments are, we need to look at your affordability. So if you have a lot of credit out there and a lot of potential payments, even if you're not using it, it can reduce what you're able to borrow moving forward. Okay. Any questions about, maybe I'm going to go to the next slide because I'm getting into the disadvantages, and I feel like that's what we're talking about here. So like I was saying, one of the disadvantages of having too much credit or overutilizing your credit is that it takes away your ability to borrow more or to obtain more credit. So the way the banks look at your credit report, it isn't just for your repayment, it's how much you're paying out already. So by regulations, we can only go to a maximum of, you know, for example, the big banks that are federally regulated, they go to a maximum of 40% of your gross income. Credit unions are regulated provincially. We go to 44%. So once you've reached that, and you need to consider, you know, if you make, say, $4,000 a month in gross income, so that's before taxes, you then have rent of, say, $1,500. Heat isn't included in that rent, so you then have another $100 on that. Say you have a car loan, and that's another, you know, $400 payment. You have, let me think, what else could there be? You have a credit card and you have a balance owing on that. So say that's another $50 payment per month. We have to take all of that off of that gross income. And if it's more than 44%, we can't extend you any more credit. Okay. And we can't take you past that 44%. And a lot of people find this when they're going to purchase a home, because they have credit cards and things outstanding, and those payments are adding up. They can't borrow as much as they would like to for a mortgage. So our suggestion can be, you know what, if you can pay that off, pay it off and get rid of that card. You know, you have 5 others. So you have to be smart about getting the credit cards and building that credit. What are some other disadvantages of having credit and debt.
I think have too much credits will encourage you to consume. It's a kind of consumerism. Yeah, buy more credits, buy more goods you don't actually need.
Exactly right. Your spending can get out of control because you have this ease and simple way to purchase without actually having the funds in your account. Yes. Yeah. It can be much harder to budget if you're not dealing with cash. Anything else that you can think of? There aren't really too many more disadvantages, but those disadvantages are huge. That's the thing. So, getting into debt that is more than you can repay, affecting your credit history and your credit score negatively, those are huge. And they affect you for quite some time, and they affect more than just your finances. It's one of the reasons why we talk about finances and why I'm passionate about financial literacy, is because we worry, we lose sleep over our finances. And one of the major causes of relationship breakdowns are finances. So, having the credit or the debt it's going to affect your whole life if it gets out of hand. So you need to be very careful with it. And it can affect your life going forward for a number of years. So one late payment will show on your credit bureau for as long as you have that credit card. Okay, so keep that in mind. If you can at least pay your minimum payment, that counts as a full payment for the credit bureau report. You don't have to pay the balance off in full each and every month, but you do need to maintain those minimum payments. The other disadvantage is the interest that you're paying on an item. So for example, even if it's a car loan, you're paying X number of dollars for that car, but by the time you've paid that car off or that loan off in 5 years, you're paying significantly more for that. And that is a consideration. Okay. Any questions about anything we discussed there? No? Okay. Now, I don't want to be really, really negative about credit. It does have its place. First thing, when it comes to obtaining credit, is you should be very honest with yourself. Are you very financially responsible? Do you budget and stick to that budget? Or are you more of an impulse buyer, and when the money runs out, that's when you're done shopping? And everybody lives within those ranges. Whatever you are, that's how you should deal with credit. If you are an impulse buyer and you spend until the money is gone, a credit card with a very small limit or no credit card at all might be the right way for you to go. If you're very disciplined, a credit card that you use for, emergencies, or you use it because there's a points or travel reward system that you really like and can take advantage of, that's great. But those extra rewards, they encourage you to spend, and it can be a bit of a vicious cycle to get out of. Okay. There's something extra in the chat there, Brenda? I saw the number change.
Just said impulse buyer. So yeah, if you're an impulse buyer, you probably don't want to have a very high credit limit.
Exactly. And be very careful. Again, my own personal example, and I'll let you know a little bit more about myself. I have 2 adult children. They're 24 and 22. So the younger one just graduated. The older one's still in university. So the younger one got a job, as soon as she graduated. It's great. Her credit card company just bumped her credit limit from, I think she said it was 2,000, and they just bumped it up like that overnight, no application, nothing. They offered it to her. All she had to do was say yes to accept, bumped it up to 7,500. If she actually used that full limit, I know her nor I would sleep at night. So you do need to be careful about those things. She is quite disciplined. So, she did talk to me about it. We decided that yes, she would take a portion of it. So she called her credit card company and she didn't take the full 75. She took a lower amount, but because it was pre-approved, they could still do it for her on the spot. And that was something that she was comfortable with, but also, it's there, it's helping her build her credit a little more. But also she knows that if she's to go and get, say, for example, a car loan or something like that, if needed, she can lower that limit back down by her own choice to give herself more borrowing room or the capacity to take on more credit. Okay, does that make sense for you guys? Okay, so it's kind of another, could be an advantage for credit or also a disadvantage for credit, is especially with credit cards, they will bump up those limits on you automatically. And people think, great, I'll take it. You need to think long-term, you need to think the full picture. Okay, and it doesn't hurt to talk to your banker. I'm going to say this, and I say this with every session I do. Have a relationship with your banker. We don't go into banks anymore because everything can be done online or on your phone. But have a relationship with your banker, somebody who will listen to what your goals are, your financial goals, somebody who what you feel is going to explain things to you, not to say, oh, this is what you do. No, they need to educate you and let you know what your options are. If the person you're sitting in front of, you don't feel that that's what's happening, get up and go to the next office. Okay, you need to find somebody that you communicate well with, that you feel has your best interest at heart. Okay, finances are huge. And having that relationship, this is stuff that you can discuss with them. My children use me, they trust me. I won't steer them wrong. You need somebody with your finances that you feel won't steer you wrong. And I also say this, if you want an opinion, ask your friends, but if you want advice, go to the experts. So finances are the same as anything else. If you have, a cut that doesn't look like it's healing well on your hand, and you go to your friend, like, what do you think of this? Is this normal? Your friend's like, yeah, that's not a problem. I had a cut like that last month and it went away. Don't worry about it. Next thing you know, you have to go to the hospital and get antibiotics by IV because that was not okay. Your body couldn't handle that. So you should have gone to the doctor to get the proper advice, right? Your finances are the same way. What works for your friend doesn't mean anything for you. Okay. All right. We're going to do a little activity and it's about reading your credit card statement. We're going to do this kind of quick and then we're going to take a break. So what are some of the main things that you should look at or need to look at on your credit card statement? And actually, how many of you actually look at your credit card statements? Brenda? Yeah. That's great.
And one of the reasons I look at mine is I do have a cashback card. So everything I buy goes on my credit card. Whether it's a Tim Hortons coffee or my groceries or whatever, everything goes on my credit card. But I'm luckily in a position where every Friday, I don't wait till the end of the month, every Friday, and I'll do it when we finish here, I go online, I look at my balance, and I pay it off. So I'm very, very, very frugal, which means cheap. And so I don't like to pay any interest. But I like to go on and check my credit card statement regularly so that I can see if there's any charges that I didn't make number one, because that can happen quite easily. But I also like it because then at the end of the month, I can actually see, you know, what did I spend on groceries? How much money did I spend on gas? Those types of things. So for me, I can, you know, really track my spending because everything other than going to the farmer's market on Saturday morning is on my credit card. And it gives you an idea of where your money goes for me. And I know, you know, cash budgeting can work that way as well, but I can quickly see if I'm overspending on, you know, running to fast food in the run of a month. Because at the time, $10, $15 doesn't seem like that much. But if you've done it 3 or 4 times that month, then all of a sudden you're at $60 or $75 and you're going, that's too much. I shouldn't be doing that. So for me, keeping an eye on my statement, and like I say, for me, it's weekly, you know, just allows me to ensure that I'm keeping on top of my spending and I'm not paying interest. And I know, you know, there's been times in my life where I had to carry a balance because I simply couldn't afford to make my payments. Luckily, I'm, you know, at a different point in my life now where, you know, I don't put it on my credit card unless I can pay it off, you know, other than, you know, emergencies that come up, but then I do my best to make sure it gets paid off very quickly.
Yeah,
that's why I do my credit card statement.
Exactly. And, you know, one thing that you said there is really key is just making sure that there's nothing charged to your credit card that you didn't do, because mistakes happen. You know, there is a lot of fraud out there that you need to be aware of. So you should be checking your credit card. If it's not the statement, then checking online to see what purchases are actually registered there. But if you're looking at your statement itself, there are some things that you're going to want to know. So the first box, A, B, C, and D, of course, your account number, your statement closing date. So that's important. Your statement closing date is not going to be the same date each and every month. It's going to be the same business day of each month, but it will change, you know, by 2 or 3 days ahead or behind the date that you see there. So this one I'm assuming is, I'm going to say November 9th of 2013. These statements, like next month, it could be, you know, December 10th when the statement's printed, or it could even be December 7th when it's printed. It will change 2 or 3 days on either side of that. Okay, so your statement printing date isn't always going to be the same date. Why is that important? Why do you want to take note of that? Any ideas? And your statement printing date will determine your statement due date or your payment due date. Okay, so there's generally what we call a grace period. And for most credit cards, it's 21 days from your statement printing date to your payment due date. And that's important. We'll get to that in a second. But your statement printing date or your statement closing date, same thing. You need to understand that this is a snapshot of your account on that day. Okay? Anything that you've charged after that day is not going to show on this statement. Any interest that's charged after that day is not going to show on this statement. Okay, so it's a snapshot of what has happened up to that day from your last statement printing. You know, your credit line, that's what your credit limit is, your full credit limit. Available credit, that's your credit limit or credit line minus the charges that are outstanding on this bill on that day. Okay. And again, as you go down the statement, your account summary, it will tell you what your previous balance, how many payments you made. It breaks down the statement, basically, your purchases and other charges on this statement. If you've had any cash advances, if there's any other charges, credits would have been anything that you returned. So keep in mind, this is another important fact about credit cards. Your credits are anything that you've returned. Your payments are what you've actually applied to the card. So if you have a balance owing of, say, $50 on your statement, and you returned an item for $50, that is not your payment. It is not your payment. You still have to pay that $50 by your statement due date to have it registered as a payment made in full to avoid interest. Okay, does that make sense? So a credit to your credit card is not considered a payment. So, because I know a lot of people do this, like, oh yeah, I owe, $200 on my statement, but I returned something for $50, so I only have to pay $150. No, you need to pay the full $200. Okay, you'll end up with a credit for next month of that $50. Can anybody tell me the difference between the purchases and cash advances? How are they treated differently? There's a couple of clues right on your statement.
Are cash advances when you take money directly for the credit card?
Sorry, when you take the money, what was that?
Yes, when you take money, when you take
Yes.
cash from your credit
Your
card.
credit card. Yes,
Oh, okay.
exactly.
Oh, I didn't know that.
Yeah, cash advance is when, so if you use your credit card at the debit machine, for example,
Mm.
that's taking a cash advance. Sometimes when you pay bills using your credit card, it goes through as a cash advance. So you need to be careful that way too.
I think when you take cash advances, you immediately have to pay an interest, right?
That's correct. That's another difference. You immediately pay interest.
Okay.
I see there's a couple of things in chat there, Brenda. Are there answers to?
Yeah, Tanika said there's a charge. Well, Tanika and Tanya both basically said you get charged a fee for cash advances.
You do. Absolutely, you do. As well, if you can look down to about the middle of the statement, so where it says J, right above that, you see your purchases have an interest rate of 19.8 and your cash advances have an interest rate of 21.8. So cash advances incur a higher interest rate. Okay. I see we have a few more comments in chat there, Brenda. Is there anything else?
Yeah, it's basically the same thing. Tanya said there's also the interest might be different, higher, and
Yeah.
pay attention. Somebody says pay attention to the overdue fee as well.
Yes. Yeah, there's an over limit fee. So even this is another one that can catch you. So say your credit limit is $2,000, an emergency came up and you charged $2,000 on your card. Say you had to do it through a cash advance. That interest that gets charged immediately puts you over your limit of $2,000. You're getting charged a fee for being over limit. So you need to be careful about those things too. I'm going to explain a little bit about how the credit card works, how interest on purchases works. Okay, so we talked about the statement printing date or the statement closing date. Say, for example, you bought something today for $50. Your statement prints on November 1st. You then have what we call a grace period of 21 days. So that means your payment of the $50 will be due on November 22nd. Okay. You pay on November 21st, you pay $45. I'm like, okay, my payment's made. That's not a big deal. Interest on $5, nothing, right? I'll get that caught up next month. That interest is charged on your full $50 from today until that payment of $45. And then the interest is charged on the remaining $5 until you pay that off. So you do not get purchases interest-free from the date of the purchase until your statement due date. Interest gets backdated. Okay. And that's something that a lot of people don't understand. Your interest will get backdated to the date of the purchases if you do not pay your statement balance in full by the due date. So even if you pay on the due date $49.99 on a $50 payment, your interest will get charged back to that day that you made that purchase. Okay, any questions around that? Okay. In the interest of time, I'm going to say that we take a 5-minute break. So I've got 10:15. We'll come back at 10:20. Is that good? And we'll start talking about different types of credit and debt. Okay. Thanks, everyone. We'll be back in a few minutes. All right. Hey, sorry guys, I'm lagging a little bit behind. I can't seem to leave my office without getting nabbed for something. So sorry about that. I'm hoping everybody's back and ready to continue on. I know some people step away from their computers and phones and stuff. So if you can hear me, we're going to start again. Thank you. And I'll just go back to sharing my screen. We're going to talk a little bit about, actually, before we move on, does anybody have any questions about the credit card and what we mentioned, some of the pitfalls around credit cards or their statements? No? Okay, again,
Good
quiet
morning.
bunch, but let's keep moving along. And I do apologize, I am long-winded today. So some different types of debt. As you can see here, there are credit cards, lines of credit, loans, mortgages. And we discussed how interest can be different on each of those. You know, I guess let's talk a little bit more in depth about the different types of lines of credit. Can anybody tell me some of the different types of lines of credit?
We just do have one question. I think it had to do with the credit card
Sorry,
payment.
Brenda, we still can't hear you. You're not on mute, but we can't hear you. Nope, still no.
How about now?
No.
I can hear her. I can
don't
hear
know what
you, Brenda.
happened.
Oh,
Brenda,
you can hear me? Okay.
I can hear you.
Oh, you know what?
Do you want to read the chat then,
Sorry.
Natalie?
You know what? That was me. I'm sorry.
Oh.
Sorry. Go ahead.
All right. There is a question. I think it was from the credit card statement. Is there an extra fee charged for every payment made with a credit card now? I heard it was going to happen soon, but not sure.
Okay.
So if you paid 3 payment, like for me, I hadn't heard this, so this might be new information for me.
Yeah. It is new information, but it's not when you make a payment. It's when you use your credit card to pay for a purchase. They are now saying that the merchants, so the stores, can actually pass along their charge for accepting credit cards to the consumers. Okay, so I'm not exactly sure where that sits right now, but there has been some information about that. We suspect it is going to come through. So right now, by regulations, stores, companies cannot charge for you to, if you decide to use a credit card. If they accept credit cards, that's part of their cost of doing business. But for some reason, that regulation is changing, and they can, not yet, but coming, they will be able to pass that charge on to us as consumers and clients.
Yeah, and I think I did hear something about that. They had to let you know before you finish the transaction that there would be the additional charge. And I do see, I mean, a lot of small merchants will say, you know, there is a 50-cent charge if you're, you know, under $5, let's say, which is probably illegal for them to do, but a lot of small merchants do that. But yeah, that'll be something to watch for somebody like me that uses my credit card for everything.
Same here. Yeah, same here. So it could drive up the costs. Absolutely. That was a great question. Thank you for bringing that up, whoever that was. Thank you. Anything else? Okay, no. All right. So back to our line. We know about credit cards. There's all kinds, multitude of credit cards. And actually credit cards, lines of credits, those can be broken down into some other categories as well. So for example, credit cards, you have department store credit cards like the Bay, or even Canadian Tire can be considered a department store credit card. So they're not always connected to a well-known credit card company like a MasterCard or a Visa. It is their own, although, sorry, Canadian Tire is connected. The Bay has their own financing department. They do their own credit, or at least they used to. Do they still do their own credit cards, or are they connected to a MasterCard or Visa? I'm not even sure anymore. These things change so quickly all the time. But traditionally, there were department store credit cards and bank credit cards. Now they seem to be all one and the same. They're generally, connected with MasterCards or Visas. And even, back in my day, MasterCards and Visas were treated differently. And, MasterCard wasn't accepted everywhere that Visa was accepted and vice versa. So you had to carry both. Not so these days. So one credit card should be able to suit all of your needs and be accepted anywhere you go worldwide. Lines of credit. So there are a bunch of different types of lines of credit. Does anybody have any idea about some of the different types? No? Okay, that can be kind of a confusing one. So we have the most common, an unsecured line of credit. So based on your own credit worthiness or your character, as seen by the banks or lending companies, you can get a line of credit that is not attached to anything. Generally, they have lower limits on them, $10,000, $5,000. But if you have a large income and fantastic credit history, you could get more than that. And they're generally used for, short-term, kind of like a credit card, but say, for example, you had an emergency, you had to use your credit card. And then when it comes time to make a payment on that credit card, you're not going to pay it off in full. A lot of people will pay that credit card using their line of credit because the line of credit most likely is going to be a lower interest rate. So it's a lot of how we see, a line of credit, an unsecured line of credit being used. The exact opposite to that is a secured line of credit. So a secured line of credit most times is going to be secured by your property, and they call them home equity line of credits. So you use the equity that you have. So equity in your home is what you owe free and clear, that portion of the value of your home. And we can go up to 80% of that with a line of credit. It gives you a lot of flexibility. It's a great interest rate because those lines of credit are usually the bank's prime rate plus 1 or 0.5%. So they're usually the best interest rates you can get on something that is flexible. If you have something like that set up, you don't have to keep going back to the bank when you need funds, for example, a car. You can just write a check from that line of credit, for example. But we also have things like student lines of credit and investment lines of credit. Those are usually more specific to investing in retirement savings plans, but they are available. So they do, lines of credit offer a lot of flexibility, better interest rates, and they can be for specific purposes, okay? And then we have loans. Loans can, again, be secured or unsecured. They can be for all sorts of varieties of reasons. For example, at CUA here, we have a loan that is an energy efficiency loan. It's a really decent interest rate as far as loans go, but the program is designed for homeowners to be able to finance anything that makes their home more energy efficient. And it's really, when it comes to CUA, it offers the best or lowest interest rate that we offer on loans. And it's to help Nova Scotians, be more energy efficient in general. And then we have mortgages, and those, I could go on for days about mortgages. There are a variety of different types of mortgages. And when we talked about fixed and floating interest rates, your mortgages can have either one of those types of interest. Your credit cards tend to be a fixed interest rate, but they do from time to time change those interest rates depending on what interest rates in general are looking like. So if interest rates go up a lot, the credit card companies can increase their interest rates just to keep up with the earnings, basically, is what it comes down to. Lines of credit are attached to that prime rate, so they would be fluctuating or variable interest rates. And loans can be either one. Most often they are fixed interest rates. Any questions about those products? Sort of a high-level overview. And again, with this screen, we're talking a little bit about the different types. So one thing that I'd like to, I'm jumping ahead here a little bit. I'm just going to go ahead and we'll come back to these other slides. Most of you have probably at least looked into the government student loans. And you may have looked into a student line of credit. So I know I've already mentioned that a student line of credit is offered by banks, where a student loan is offered by the governments. Can anybody tell me, besides the payments you would have to make, because I already talked about that, what are some differences between the government student loans and the bank's student line of credit? Does anybody want to take a stab at it? Okay, I think we got one person.
Said, I guess student loans have a lower interest, like government student loans, and many times with a government student loan, grants are applied.
Yes, absolutely. Those are wonderful answers. Yes. Student loans can be a lower interest rate. Like I had mentioned earlier, you're not required to make any payments on them while you're in school. And you do have grants attached to those as well. Under certain conditions, once you're out of school, some of those loans can be forgiven. And if you're not working, or I believe they changed the requirement that you don't need to make payments on your student loans until you're earning $40,000 a year now, which is fantastic, because just before that it was $25,000, and you're barely scraping by at $25,000, unfortunately. So I don't know how they expected people to pay their student loan payments as well. So there is.
Can I say something here?
Sure.
So it's curious that, you know, students, and this is where kind of this whole kind of credit debt is really interesting. You can get credit cards at 18 or 19 or whatever. Okay. And you're obviously some people use that money well. Most people at 19 are not using it that well.
Yes.
And you can rack up lots of debt. And then you get the student loan, and then you pay back when you're making $40,000. There's an understanding that you really can't make the payment. Really, at $25,000, if you divide that monthly, if that's what you're making, you can barely scrape by. So when you're making $0, you're getting access to thousands of dollars of credit cards, right? But when you actually have to pay your bills, right, they're like, you know, it's okay. We understand that you now make $25,000. You can't provide for yourself. So we'll give you a break. But in that meantime, there is still interest being put on that after you graduate. So I think that there needs to be an understanding that it's not like, okay, you don't pay till there's 40,000 coming into your personal coffer, but from the moment you graduate, you're still accruing interest on those loans. So it's not only the matter of students being responsible, it's being able to say no from the get-go. Because then if you're a student and you really don't need a credit card and you decide not to get one, you're much more prepared to perhaps make small payments between when you graduate and when you start to make 40,000, because that interest is compounded all the time, right?
You're absolutely right, Natalie, and that's a really great point to make. Yeah, the government is trying to be good to us, but they're not free. It's not free. That interest is still going to accrue. That's absolutely correct. One thing that I would caution about though, Natalie, is when you say don't get that credit card, I would still say get that credit card, but like I said, only put your cell phone bill on it and put the card itself away so you don't use it, because you do want to establish your credit when it's easy to get that credit, but you want to be responsible with it and not actually get yourself into debt. The other thing that this brings up, and I'm really happy that you did say all this, Natalie. The other thing that this brings up is the biggest difference between a student line of credit from a bank and a government student loan. A student line of credit will most likely require a co-signer who has the ability to repay it. A government student loan is based off of your need. Okay, banks' ability to repay, that's what we look at. Everybody says, oh, the bank wouldn't help me when I needed it. We look at your ability to repay, not at your need. We look at your ability to repay. Government programs, whether it's government student loans or any other type of program, like child tax benefit, it's all based off of need. Does that make sense? Okay, so not everybody's going to be eligible for a student loan. Not everybody's going to be eligible for a student line of credit. Chances are, if you can get a student loan, you might not be eligible for a student line of credit and vice versa. Okay, because one is based off of your ability to repay, the other your need. Sure, Fabiola, go ahead.
Yeah, I think also the student loans is just for students from Canada, right?
Yes. Yes, because it's from the government of Canada, but I believe you're best off going to, and I'm not sure what they call them anymore, but like the finance advising department of the university. I don't know if there's bursaries, there's always scholarships and stuff like that. Apply for everything you can possibly apply for, because there is money to be had out there.
Yes,
I should say as well, there is in Nova Scotia, so two things, like I moved here from the US, and there are international scholarships and international grants for students. It takes time to sort through them. It takes no time to look for them, really. Sometimes so there's student advising, and there are on campuses, every campus has their in-house scholarship programs or whatever, but internationally, there may be scholarships for, let's say, students of Spanish descent studying in Canada or studying in America. There are many, you just need to be able to write that essay or say whatever it is. A lot of people don't, like Myra was saying, a lot of people don't take advantage of them because there's a little bit of work behind every one of them.
Yes. Yeah. And, sorry, go ahead, Brenda.
I was going to say there is a question in the chat, but you guys can finish your conversation and let me know when you're ready for it.
Yeah, I know when my children were applying for university, there were a few stories that, apply for everything that you can when it comes to scholarships and bursaries, because even if you don't 100% qualify for it or think you might not qualify for it, one story was, and this came from the university rep, a male student applied for a bursary that was supposed to be for female students, but he was awarded it because nobody else applied. No female applied for it, so he was awarded it. So apply for everything.
Yeah, thank
Takes
you.
a few seconds. I shouldn't say a few seconds. It does take work, but it can be worth it. Definitely. So Brenda, you had a question there?
Yeah, Sydney has in the chat, I don't have a credit card, but am looking into it before I graduate to pay off loans. Are there different options to pay off loans that are smarter, like as much as you can immediately after, or increments to build credit? I'm just not sure how it works.
Okay, that's a great question. And I'm kind of feeling like we should go off the slides here completely because these discussions are going to cover the next few slides. Let me stop sharing my screen. So that's a fantastic question. So what are your options to pay off loans? It really depends on your situation. So your finances are going to be as individual as your fingerprint. Keep that in mind. So again, that's why whatever worked for your friend isn't necessarily going to work for you. And you really need to consider your own personal needs and your goals, okay? So there's a few trains of thought on that. You're going to want to, so basically, this is what I've told my children when it comes to student loans, okay? Until you graduate, there's no, so keep in mind, student loans, government student loans, no interest until you graduate. So they qualified because I'm a single parent, they qualified for student loans. So we took the student loans. Even though I have some education savings for them, we still took the student loans because in my role, I'm able to invest that money and make more money for them. So when it comes time that interest is going to be charged on their student loan, we actually have most of the money to pay it off because I've invested and built that money up rather than using it out of my own pocket for their education. Okay, so if myself having the know-how, and if it was one of my colleagues, I would totally suggest that. Somebody who isn't financially savvy, I wouldn't suggest it to them, right? Because there's going to be that stress, and it's going to be, am I doing the right thing? Am I, are my investments the right ones to be in, and all of that sort of stuff. So do you want to pay your loans off as quickly as possible? It's always great to be debt-free. But if paying those loans off as quickly as possible is making you incur debt elsewhere, then no, it's not a good idea. You need to be reasonable in how quickly you're going to pay them off. So for example, say you're paying off your student loan as quickly as possible. You're putting all kinds of money down on it. This month you managed to put $1,000 down on your student loan. Yet all of your gas and groceries went on a credit card because you didn't have the cash to pay for them. So now instead of paying, I'm not even sure what student loans charge in interest anymore, but let's say instead of paying 5% interest, you're now carrying a balance on a credit card that's charging you 20% interest. That doesn't make sense. Okay, is that clear? I'm not sure, like sometimes these are concepts that are hard to grasp. When you're looking, sorry, go ahead.
I was just going to say, kind of with the way the question is being asked as well, is one of the key things is, as you're alluding to, Myra, is, understand what interest you're paying on which loans and therefore which is better. So if your loans are at, 5 or 6%, so maybe it's you have not a Canada government student loan, but you have some other loan that you're using to pay for a car, for education. Putting that on a credit card may not be your best option if the credit card has a higher interest. But some people will take out a loan to actually bring all of their debt into one and consolidate if the loan has a lower interest rate. So I think that's the key, is trying to figure out which are you going to pay the least interest on.
Right.
Yeah.
And that's why it's really important to have a relationship with a banker, somebody that you know can understand what you're asking about and can look at your overall picture and say, you know what, this is what I'm seeing based on the information you've given me. And this is the action plan I think would be best for your situation. So I know we have people who, you know, perhaps, you know, don't qualify for consolidation loan like Brenda was talking about, but we can come up with a budget for them, and we can come up with a plan to eat away at, you know, usually it's credit cards that people need to consolidate. So for example, I work with, I do financial literacy for a couple of different groups who are, for various reasons, disadvantaged. So they wouldn't qualify for a consolidation loan. But what we do is we develop the budget. We see how much money they can actually use to make payments on these credit cards. And then we look at a couple of different things. We look at the different interest rates that each of the credit cards is charging. If they're all charging the same interest rate, then we work on the one with the smallest balance first, because you see that go down that much faster. And once that's gone, there's that sense of accomplishment, right? So it gives you sort of that boost to keep going on to the next credit card, pay that debt down. You see the results. So there's all those sorts of things to consider. And that's why you need to have somebody that you work well with and has your best interests at heart, can give you the right advice with the knowledge behind it. So I think I saw in the chat that was answering your question somewhat, but I hope it answered some other questions as well that might be out there. So it's really easy to get ourselves into a lot of debt. It's not as easy to get out of it. You know, same as anything in life. It's easy to, it's hard to have good habits, no matter what part of your life you're talking about. It's hard to have good habits because the other stuff is just, you know, can be so easy. You know,
Fun.
running out for meals, like Brenda had said, running out for meals instead of cooking. That's easy, but then there's the consequences of that can be, you know, widespread depending on how much you're doing it.
So Sydney just wanted to expand a little bit on she said, or they said, yes, that helps. My question more, so if I have saved and have options to pay mostly or half, should I wait or pay as much as I can, as long as it does not lead to debt in other areas?
Okay, so in your specific situation, this is what it comes down to. Is your money earning more than what your debt is costing? Okay, so this gets a little complicated. I saw Brenda shaking her head. Again, I'll go back to the example of my children's education fund and the student loans. If we had to do their education on a student line of credit, I would have to look at the interest rate that is being charged as opposed to what I'm earning on my investments. So for example, if you're being charged 5% interest on your debt, but you're earning 8% on your investments, it doesn't make sense to take that investment and pay off that debt, because you're actually earning, when you look at the difference, you're earning 3% more than what you're being charged. So you're actually making more money. Now, if you're being charged 5% debt and your investments are only making 3%, no, get rid of the savings, pay off the debt, because the debt's costing you more than what you're making. Does that make sense? Okay. Thank you, Sydney.
Yeah, no, a great question. The only other little piece that I would put in there is, you know, paying it all off is great as long as you still have some of that rainy day savings, because once you do graduate, you're going to have to, you know, you might be moving to a new apartment, you might have to hook up power, you may have to, you know, maybe buy a car because a new job has come up that requires a vehicle. So I would Personally, if it were me, I hate debt. I'll be the first one to admit it. And so I always want to pay off as much debt as I can, but you have to just maybe give yourself that little bit of leeway to think, well, what does the next 6 months look like? And do I have some savings? So, you know, if you have enough to pay all of it off, maybe right at the beginning, you only pay half and you just put that money away in an interest earning place and just see what the next 6 months look like until you get your feet under you. And then maybe you can say, yep, I'm going to pay off another chunk of this or get rid of the debt completely. And I love to get rid of debt.
Yeah.
That's me personally.
And, Brenda and I are probably, I can kind of tell we're of two different camps here. And you'll hear this a lot as you get older. There are two camps or two beliefs around mortgages. There are the people who believe you pay your mortgage off as fast as you can, just get rid of it. And there's people like me who say, no, that's the lowest interest rate you will pay on borrowed money ever. So don't pay it off fast. Use the money that you would have used to pay it off to invest and make more money. So definitely, I can always tell when there's two different camps here. So again, back to those principles. Number one is your money making more than the debt is costing you. And then you look at the balance part, like Brenda was saying, is paying off that debt going to put you into a position where you don't have, if an emergency comes up, you just can't handle it and it's going to incur more debt for you. So there is that balance part of it as well. Okay. So I know we're getting into, we're down to our last few minutes here. I did want to talk about, because it's something that was on an earlier screen, but it is part of the slides later or closer to the end. We talked about the term of a loan or the term of a mortgage. So not as far as terms and conditions, but that chunk of time that you have an agreement in place for, whether it's a fixed or variable interest rate. So I said the best example of this is a mortgage. You have a 25 to 30 year amortization. So an amortization is the length of time that it takes you to pay that debt off in full, okay? A term is the length of time that you have a contract in place for that entire amount. So a mortgage, 25-year mortgage, say it's 25 years to pay off $300,000. You can then choose within that 25 years, 1 to 5 year term. And once you enter into that contract for that term, there is going to be certain terms and conditions within that, including your interest rate, your payment amount, the frequency of your payments, prepayment privileges. So can you pay more on it without any penalty? The penalty, should you break that term early, will also be included in that. And then at the end of the term, you get to renegotiate those things again. So, you've got to consider, you could have a long-term, I had mentioned our energy efficiency loans for heat pumps and things like that. They can be over a 10-year term, but we break it into 5-year chunks. So the first 5 years, you have a particular interest rate. Your payments are, this much per month or bi-weekly, whatever you choose. And at the end of the 5 years, we give you a call and we say, okay, interest rates are about this now. What would you like to do for the next 5 years to pay this off? You can either pay the rest of the remaining balance off in full at that point with absolutely no penalties. Although our loans don't have penalties, you can pay them off at any time without penalty. Or you can continue with a pretty great interest rate for the next 5 years and just pay it off by your natural payments. So that's amortization versus term. And I hope that's clear, because that can be a concept that's, generally loans are 5 years and they're done. But mortgages and other types of loans, usually for particular products, can have longer amortizations, and then the terms are within that until you pay it off. Any questions? We've got about 5 minutes. Any questions or anything that you want to ask specifics about? Like those questions from Sydney were fantastic. I think everybody learns a lot from those types of questions. So open forum, what do you have for me, guys? What questions? Okay, we still have a quiet bunch here. I really appreciate the questions that were asked. I appreciated definitely the participation. Even though you're a bit of a quiet bunch, it was still good participation, so thank you. I am going to put my email address in the chat in case there's anything that you're feeling is a little more personal or specific to your own situation. If you want to email me, feel free. I'm more than happy to answer those questions.
There's a good question in chat, and it basically says, as an international student, would it be best to start with a credit card or a debit card? So maybe you can just tell a little bit the differences between those two.
Okay, chances are as an international student, I'm not sure that you can get a credit card in Canada. As an international student. The reason being is that you can, yeah, Fabiola, do you have a credit card here?
Yeah.
Okay.
I have
Yeah.
one. I opened my account in Royal Bank, and they went to the university and offered us a credit card without interest. It is a great option. Yeah.
Without interest.
Yes, or I think it's without interest or a lower interest. I'm not sure, but I think it's something special for students.
It would be, so I know RBC has a program for international students, but in general, unless, so you would have to, you definitely have to have your student visa in place, and that would have to be proven to borrow anything in Canada. The reason that you need to prove those things is because if you're just visiting, we don't have the right to chase you down in other countries to repay your debt here. So some banks don't deal with international students or people that are on work visas. Some do. You know, when it comes to credit card or debit card, as an international student, if your plan is to return home after your studies, I would suggest debit card, because you don't need to build your credit in Canada, and your credit history in Canada does not translate to any other country. It's just within Canada. Okay, you can always be asked to supply. So if somebody is moving, like I'm sure Natalie, when she moved from the States, may have been asked for her US credit report. That happens. However, if we're looking at, you know, a credit report from, say, France, we might not be able to read it. Well, that's kind of a bad example. We might be able to read it here. But another country of a language that we don't know, maybe we can't read that credit report, so it really means nothing to us. So if you're planning on returning home, I would say debit card. You're not going to get yourself into any trouble. You're working off cash. A lot of the banks and even credit unions have Visa or MasterCard debit cards that you can use for online purchases, but the money comes directly out of your account. So it doesn't affect your credit history at all, but if you're going to be returning home after your studies, you don't need to worry about it. If your plan is, as many international students have this plan, your plan is to stay in Canada, then yes, get that credit card, start building your credit history. But again, be very responsible and cautious with that credit card.
Yeah.
Okay. So you're on mute, Brenda.
Of course I am.
There we are.
There we are. Tanya said she's glad you mentioned the idea of getting the student loan first, and then using, you know, the savings to build the money, as her oldest just started university, and that's really helpful. And then somebody else said a friend advised them to open a credit card to establish my credit in the future, in case I wish to work on my PGW So, and
I'm sorry, what is PGWP?
that would be their, I think it would be their
Permanent residency, maybe?
yeah, I think that's what
Post-grad work or post-grad
Post-grad working permit. Okay, thank you. Thank you.
perfect. I wasn't 100% sure either. I was thinking residency because we've had students work with us that are working on the residency, but
Okay.
that's a new one for me. Post-grad working permit. Perfect.
Brenda
Yes.
and Myra, I actually have another student workshop that starts at 11.
Okay.
Great, thanks.
Okay, thanks, bye.
Thanks, Natalie.
Okay, bye.
All right.
Right, so
Excellent.
I think that's covered all the questions. Brenda, I can stay a couple more minutes if needed.
That seems to be everything in chat. We've got a whole bunch of thank yous coming up, and that's awesome. And thank you for sticking with us, both Myra and Danny. Danny, we didn't see too much of, but he's been listening in. And you know, the information from Myra was there on her email address if anybody wants to see that. And I will be sending a recording to Natalie, so she'll have it. I know there's been a lot of information, and sometimes it's good to be able to re-listen to some of the parts of it as well. So I will send, probably on Monday, I'll send Natalie the recording, and then she'll get it out to everybody that registered for the session as well. So thank you, Myra. It was awesome as usual.
Thank you, guys. I really enjoy it, as always.
Excellent.
Have a great day, everyone.
Thanks, everyone.